Well, my next guest is known as one of the straightest shooters on Wall Street with the track record of looking around corners and making really big calls before they happen. And right now, well, he's not liking what he's seeing. In fact, this week he shook the market up when he remarked that almost all financial assets are now overvalued. So let's bring in DoubleLine Capital founder, CEO, and CIO Jeffrey Gundlach. Jeffrey, great seeing you. You've been pretty adamant. I want to start with private credit because you have been so adamant about this. You know, last week you pointed out there's never just one cockroach, but even before then you posted about pay in kind or PIK, and you know that's sort of represented in that Blue Owl stock, which is crumbling. Explain to the audience what exactly is going on here.
Well, we had a little bit of volatility earlier this year with the tariff tantrum, and then everything came back to calming down. And throughout the summer into the fall, we've kept at the tightest credit spreads we've had in a long, long time in the bond market. And there was a lot of easy financing, and there was kind of a one-rate sort of offerings from some of the CapEx and the data center stuff and all this. But in recent weeks, and maybe it has something to do with the government shutdown and the data not being around, so now people have to look at more anecdotal data, like layoffs of 30,000 at company A and 15,000 at company B, and the ADP data, which is not terribly reliable, but it's been weakening. The household survey is usually more accurate than the establishment survey at turning points, and that's definitely been weaker. So all these things have started to lead to observable changes where the market seems to be bifurcating. So you have triple C high yield spreads have widened out, not insignificantly. High yield spreads broadly have widened out. Corporate, even investment grade corporate spreads are starting to widen out a little bit. And then the private credit thing is starting to be less of a theoretical shakeout where some will be survivors and some may experience troubles. And now starting to see sort of the canaries in the coal mine kind of falling to the bottom of the cage. And we saw one deal where it was called Renovo, where a firm, reputable firm, frankly, had the bonds marked at 100 cents on the dollar. And then a month later, they revised the mark to zero. That's a pretty big change, right. 100 is zero. And in their Chapter 7 bankruptcy filing, they stated their liabilities at about $150 million, and they showed their assets to be less than $50,000. Now, I know private credit is less transparent and unregulated largely and all this, but you think that they would all be monitoring their credit positions. It just seems weird to me that you wake up one day and you realize that the debt to equity ratio is 150 million to less than $50,000.
Right.
And that's really an interesting thing. And then a week later, out comes an article that some major private credit firms owned the same position, and the marks had a pretty wide variation on them. The high was at 91, and the low was at 77. Now, 91 to 77 isn't 100 to 0, but that's a pretty big variance. And then anecdotally, I met with one of our large insurance company clients who has very many positions in private credit, and they have 8 managers that own exactly the same position. And the highest mark during a marking period earlier this year, this wasn't terribly recently, but it was here in 2025, the highest mark was at 95 among these 8 managers, and the lowest mark was at 8. So this is starting to show up to be the problem that I've been referencing, is that private credit and private equity, frankly, is being borrowed from private equity. It's sold on a volatility argument primarily. Maybe there's some excess return for illiquidity that you can get, but it's largely a volatility argument. But if the marks are estimates as opposed to true marks, the volatility could end up being realized volatility in the future could be much more than the observable volatility in the past. And then you have the news today that a firm has a publicly traded private credit fund and a non-publicly traded private credit fund, and they wanted to merge the two because the assets, the stock price of the publicly traded one was meaningfully below the stated asset value. Well, I think market participants are pretty smart. I don't think that they're going to be, selling below the value of the assets. And so I'm suspicious if the assets are really higher value than the stock.
Right.
And the other twist was they had this private fund, and they wanted to merge the two. And when they announced the merger, they said that the private investors would not be allowed to redeem until the merger had taken place. This is kind of the thing about unregulated markets, just like the CDO market was previously to the global financial crisis. It's like the Wild West. And it starts out with a sheriff in town and things are going pretty well. But then as the frontier town grows, more people come in trying to exploit opportunity. And you get to have, maybe it started out with the good sheriff and good actors, but it starts to become highly appealing when you have massive asset inflows at high fees, by the way. And it's enticing for people who want to maybe color outside the lines a little bit. And you start to get the potential for problems. And that's what I've been talking about now for a while. But in more recent weeks, with spreads widening out in particular, perhaps being a catalyst, and bifurcation in the yields and CDS of data centers or people like that that are sponsored by major entities and ones that are sponsored by entities that are less convincingly robust, you're starting to see spreads going from very tight to one to the other to something like 200, 300 basis points, and it's happened fairly quickly. So I think that this is showing signs of stress, and you're in a market where pricing is estimated and not known. So it hasn't really been tested yet, and like most credit markets when they start out, they get tested, and it turns out that some of the ideas that were used to do new strategies and promote growth end up not being terribly sound. And so that happens, that leads people to be fearful.
Right.
And when people are fearful, they don't like being in illiquid assets. And in the global financial crisis, people couldn't fund their private lockup fund commitments when they started to draw them down. So you say you're going to invest in a fund, and the sponsor rightly and responsibly says, we're waiting for it to get cheap. We're waiting for it to get cheap. And when it does, we're going to draw your capital. But when it gets cheap, nobody has any capital because they're already locked up, and everybody thinks it's cheap now because it probably is. And you start getting capital calls, and these entities can't fund them. And so we have, I think, a mismatch here in terms of large asset pools and needs, particularly during times of some stress,
right,
and their liquidity. So this I think could be a problem. So go ahead, Charles.
No, I mean, as you were describing this, and you eventually mentioned collateralized debt obligations, and there were a lot of terms that we learned the hard way during the housing crisis, and of course there was a contagion, there was mark to make believe, anyone was making up their marks, and to your point, this becomes a groundswell of anxiety, and certainly Blue Owl, which is the company you were referring to, we had that chart up, stock is just completely falling apart. So I want to pick up on this, but also when we come back, I want to shift to the debt conversation because it's been a concern of Wall Street for a long time, but I want to point out to the audience, January 1st, 1835, President Andrew Jackson paid off the national debt, but that was the last time the U.S. was at zero. Jeff Gundlach, you've been worried about this for a long time. When we come back, let's talk about that, the potential AI bubble, and where there might be some opportunities. We'll be right back.